All right, guys, every so often, Mo and I go a little bit deeper into a company. So we're looking at Disney. And the reason being is Disney hit a peak of 200. It's now it got as low as $85, $86 a share. My brother's a huge fan of Disney. Big revenue from parks. Disney Plus is now the largest or one of the largest streaming services. So we're going to do a little bit better view on Disney. It's not all the way through to reading the 10K line by line to understand it, but this will give you a good idea of how to look at companies, because I look at companies that are publicly traded the way I look at a company that I owned. Look at the income statement, the balance sheet, and of course I use our software to help understand the company. So let's pull up Disney real quick first and look at it from an 8-pillar perspective. Oh, it's at $95 a share now.
Yeah,
look at that.
And it rebounded about $10 in the past week or so.
The all-time high was March 7th of last year at 203. And it's now, the 52-week low is $86. Now, the company is a $174 billion company. The first thing I'm going to say is, if I give you $174 billion today, are you replicating Disney?
No, this is the ultimate moat.
And this is a very, 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 very large moat. Ultimate might be up there. He might be right.
To me, this is the ultimate moat. Who's going to compete with Disney?
You might be right, actually, come to think of it.
Actually, we should just change the name moat to Disney.
Okay,
don't use the word moat anymore.
I think Warren Buffett would say Coke is the moat because there's no patent, and yet people are going to...
I will say this.
Yes.
What's the competition to Disney?
That's what I mean. And by the way...
What's the competition to Coke?
Yeah.
There's competition.
So
I'm not saying that it's like...
I will say this about... when you're reading their financials, it talked a lot about Disney Plus. There's a lot of competition to Disney Plus.
I'll give you that one.
However, they have a library that's incredible. Yeah. So guys, let's look at the revenue numbers for Disney. Okay? So these are the last 10 years. And as you can tell, it peaked and then fell for 2021 because this was going back to COVID. And then boom, all-time highs again in revenue. Total revenue here of $82 billion. I don't know why it deviated from there. Net profit. Now, here's the interesting part, guys. They were doing 8, 9, 9, 12, 11, and then this bad stream. They still haven't hit their profit levels.
No, not even close.
They're only at with record revenue, they're only at $3.5 billion in profit. So go understand, that's a big thing you have to understand. Why is their profit so much lower? But the other thing is, I want you to remember, I wouldn't focus on their PE as much. Their PE is currently 50. And immediately off the dribble, you're thinking to yourself, God, that's so high. Yeah, but their profit is down 75% on higher revenue. So there's got to be something fundamentally in the business that's causing profit to fall. Because I have a hard time believing that the company doing $70 billion is going to generate $3.5 billion in revenue and profit every single year.
Yeah, my guess would be from the Disney Plus side, how much it's costing. I mean,
how does it cost them money?
Well,
it's streaming.
They're making movies. They're making...
But they've always
content.
been doing that.
I know, but they're going at it a lot harder now.
I don't think it's going to eat up 70% of their net income. Let's go look at their free cash flow.
I don't know what it would be from then. I have no idea.
Well, that's part of the questions people need to ask. Look at this free cash flow, guys. Ready? 6.5, 8.5, 8.5, almost 10, 3.7, 3.3, $500 million, 2.3, $500 million, 1.7. I mean, it's so low.
That's terrible.
At the start of this decade, it was averaging probably 8 billion. Now the average is 1.7.
Yeah, it's bad.
I mean, there's so much room to grow here. So while I look at this more, Mo's looking up what percentage of their revenue comes from parks and recreation, because it's at least 40 or 45%.
That's what it was back during COVID.
And that was before Disney Plus really took off. Disney Plus, I mean, they have, with all their apps, ESPN, all that stuff, I think they're at 250 million users. Okay, that's a lot of users. There's a lot of revenue coming in. If everybody's paying $5 each a month, that's $1 billion a month coming in. $1 billion a month. And that probably is a big reason for their big jump in revenue, which is why I'm confused about their profit. But they might be looking at other things along the way in terms of why their profit's so low. But look at our 8 pillars here. Very little shares outstanding going up, which I'm glad. This free cash flow number, now free cash flow should multiply by 4, so that would take this down to 10. And it's still high, but guys, I think I'm okay with Disney having high debt. They have very high margin. Not currently, but in the past, their gross margin is 52%. So just a high cost structure right now. No dividend right now. That's fine. They'll get back to it. Enterprise value of 267 versus a market cap of 173. That means they have about $90 billion in debt on the company. At an average rate of 10%, they can still pay that off very easily with their profit. Revenue growth, profit. I mean, it's all here. ROIC, it's affected by cash flow, which is down a lot. Like, guys, I don't look at these X's and go, oh no, I got to avoid it. I look at it and saying it's a temporary thing. The question is, when does it rebound? So right here, showing their parks from 2021. Now, this is the year ending October 30th, 2021, or something like that. 16.5 billion of their 70 billion, or whatever the number is. It's about 25% of their revenue comes from parks. And the profit operating income, 471. So it's like, okay, I don't really, there's a lot of selling in it. I want to compare this to the past. So Mo, while you're doing this and looking further and providing more, I'm going to look at previous years and see how it was affected.
Okay. From the media side, Disney Media and Entertainment, I mean, that's a massive piece of their 50.8 billion out of their total revenue. So I was wrong. That's a massive piece that comes from that Disney Plus side. So now here, before the video started, I had the 10 quarterly report up here. And I said, one of the big things that I really wasn't a fan of that I read through this, the majority of it focused on Disney Plus, focused on this whole media side. And I was like, oh, that's a little concerning for me, because I thought that 40% is what came from the parks. It's not the case. So I actually do like that they're focusing a lot more on that Disney side, because where are they going to get the growth from?
The Disney Plus side?
Disney Plus side. That's where they're going to get a lot of the growth from.
Well, and the benefit,
they're going to create bigger margins too.
And the benefit that Disney has is they make really great content. They have a huge library of amazing content. They have sports.
And they have an amazing way to monetize it, because they could just keep, it's just churning.
Absolutely.
Nobody else has that opportunity.
And don't forget the sport. We have to remember the sports side.
The ESPN
The ABC,
side.
ESPN thing. It's like, guys, sports are where the advertising dollars are going to go as less and less people watch TV with commercials. Somebody said, maybe it was you. No, somebody said to me today, hey, did you see this commercial? I'm like, no, I did not. Because the only time I watch commercials is when I watch sports. And the commercials they're probably talking about are not affiliated with me. That's it.
They had an increase in ESPN Plus going in the quarter.
Oh, look at that. Look at the total Disney Plus.
Wow, look at that. Look at that ESPN Plus increase. 17.1 million to 20, or what is that? 17.1 million.
Hulu. I have Hulu.
Hulu's great.
Everything saw big growth.
Yeah. It's awesome.
Total Disney Plus grew 39%. That's a big,
really
big number. Paid
awesome.
Subscribers.
Do you have Hulu TV?
Yeah.
How is it?
Apart from the fact that people are telling me something that happens and I'm watching 12-second delay. I mean, apart from that, it's like, for example, prime example, the Buffalo Bills, Minnesota Vikings game this weekend, the game of the year. And I'm watching it and texting with our mutual friend, Matt, who's a Minnesota Vikings fan, lives in Minnesota. All I see is, I told him, I'm like, hey, listen, I'm delayed, so be careful. I haven't even seen, they haven't gotten to the line yet. The Bills haven't gotten to the line yet, the goal line, right? So they're going to snap the ball. And all of a sudden I see him write OMG. And I'm like, what the heck happened? Was there an interception? Like, no, it wasn't an interception. Was there a sack? And then all of a sudden I see it. I was like, holy cow. But it just sucks to know that something has happened seconds before you actually see it.
So you've had YouTube TV, right?
Yes.
How was that? Did you have lag with that? Because I don't experience lag, unless all my friends just have YouTube TV.
Oh, I guarantee you have lag.
Then we must all be on YouTube TV.
Yeah. I like Hulu because they get a lot more local games, I think. People who have YouTube complain about that. So, but guess what? Streaming is becoming more and more saturated.
It is. Look what we just said. We're talking about not even having cable.
Yeah. But it's going to become more and more saturated in terms of people having to, like, they're going to be more and more people entering the market. So with Disney, what else you got in that? That's a really nice, that's their report they just had. Look at that one. The average monthly revenue per paid subscriber.
That's what I really liked.
Let's look at that.
$6.10 for domestic, $5.83 for international, and that's for the Disney Plus side. And then you just keep coming down. Disney Plus core, Disney
But they
Plus
actually see a lot of changes that are the negative there. Why is that?
Where are you seeing? Oh, right here.
Yeah, there's a lot of negatives.
You're
1, 2, 3, 4, 5 of the 8 are dropping.
And you would think, oh, let's go right down here. See what it says. The average monthly revenue per paid subscriber for Disney Plus decreased $6.08, partially due to
mix of subscribers and multi-product offerings.
There you go.
So according to them, what they're saying there is people have taken advantage of combo deals. Like, oh, you sign up for this, you get a discount on this or whatever. Okay, could very well be. At the end of the day, it's a mix of both. One number by itself doesn't make it good. One number by itself doesn't make it bad. It's about looking at the whole package here. And if they're being honest about that, that's a good thing.
Yeah, partially offset by an increase in pricing. We know that
unfavorable foreign exchange impact.
Yeah, exactly. So
that's incredible.
I guess it could have been worse if they didn't increase prices.
Well, yeah, and by the way, the great thing about increasing in pricing, people have become accustomed to it.
Exactly.
You know, when I first got in the rental business, I used to get scared about raising rents. And then the '08, not financial, but the energy. Remember when all of a sudden gas prices skyrocketed? Yeah. Before you knew it, we were paying all the gas bills in our property in Shaker Heights, which Tim managed. Before you knew it, we were like, listen, we have to charge an increase. And guess what? Nobody fought it because everybody saw it at the pump. They were all knew that there was higher gas, but they accepted that as a fact. Even though they didn't like it, it was still accepted.
Yeah, I'm anxious to see, well, I guess we're seeing it right here, but the numbers that start coming out of Netflix, Apple TV, whatever other streaming services there are, to see if they took a hit or people just accepted it.
Yeah, and one of the things, bring up Netflix here, that I like about Disney, Netflix doesn't have shows and movies that are classics that are going yet. They have to continue to keep making more, and Disney will too. But you're telling me right now that if I had kids, I wouldn't show them Aladdin from 1995? Yeah. Of course I would, because I remember Aladdin from 1995 or 1990, whatever year it was, earlier than 95. But that's the thing. All these great classic movies that we loved as younger kids, we're going to let our kids and our nieces and nephews watch the same thing. So I look at parks, to me, the number one focus should be on expenses. When they can get back to the stable number. So let's look at this overall. I want to look at this just from a stable standpoint. Back when they were before 2020, let's go to 2019 before, $11 billion on 70. So what's that margin? 15%? $12 billion. So let's do it this. Let's add all this together. And this is what I'm going to show you guys the math. The average over these 5 years was $10 billion in profit. Let's go to the revenue. So 70 plus 60 is 130, plus 55 is 185, plus 55 is 240, plus 50 is 290. So 290 divided by 5 is 54 billion, $10 billion in profit. So their average profit margin, let's call it, was 9%. Average. 9%. So at $82 billion in revenue, they should have $7 billion in profit based on their historical numbers there. Because the 12 and 11, let's see if there were fluke years. Let's see if there were any fluke number. Well, they actually had big charges that year. Oh, look at this. This $11 billion year, $3 billion in other income. So guys, this is why we look at the financial statements. $3 billion. So this year should only be 8. Okay. There were no other write-offs in any years. So it's not like we can sit there and look at that. So overall, let's call it 10% profit. Let's go look at our stock analyzer tool.
And before you do that, you were talking, this is what the CEO said in his press release. They're hiring freeze. So you're seeing that from Disney now. This is just a way for them to control costs.
How many people they employ? Oh, right there, 190,000 employees.
But as you get down in this article, it just keeps talking about how they need to control costs. They need to control costs.
So cost is the big thing.
It's funny now. A lot of these companies.
I mean, this is this is a big jump in costs.
Oh, it's big. Yeah. But I wonder if they did it because they felt. When did the jump happen?
What happened?
When did the big jump in spending happen for them?
Right before COVID, right during COVID, basically.
Yeah, because maybe they were doing that to get out. Now
maybe
it's coming back to normal. Okay.
Okay, so I'm going to go to the stock analyzer tool.
Did you look at what the analyst said yet?
Oh, I didn't look at that yet. Good idea. Why don't you go look at that, Mo?
Okay, so looking at earnings per share growth.
Tripling.
Yeah, it's tripling. That's pretty good. And then this has to be just completely factoring in the media side because you're not getting this.
Oh, for sure.
Side, yeah. And then revenue side.
So look at it this way, $11 per share. They have 1.83 billion shares outstanding. So times 11 times 10 is 18.3. Whoa. They think this company, according to analysts on average, they think this company is going to make $20 billion a year in profit in 2026.
Have they ever done that?
No.
They even come
But they're
close.
also showing about revenue. What's the revenue estimate though, too?
Was it 200 and
120.
121? So
they're talking about taking their profit margin from an average of 9 or 10% to 16%. Guys, this is where I go.
See, this is when I see. This is the thing that bothers me about how they're putting all this weight and I think these unrealistic expectations on the Disney Plus side. That's crazy.
I mean, but look at it this way. The revenue jump isn't a huge jump. It's not going from 85 to, 300 billion.
Right.
So I'm going to sit here and I'm going to go revenue growth 0, 2, and 4%. 0% is very, very low. I get that. But they're already on record revenue and maybe they have to sit there and watch their costs.
Okay.
So profit margin side, I'm going to go with 6, 9, and 12. Let's say they hit home runs. They do that, a really high profit number.
Okay.
Free cash flow, I'm going to do the exact same thing. Now, PE, guys, it's a huge company. It's got a great moat, but the growth potential is not there. So in 10 years, I expect it to be a lower PE company about with history, 14, 15, 16. Same with free cash flow.
Sounds good.
And finally, for desired annual return, guys, you have to have it over 10% because in a long period of time, you'll make 10% in the market. So for here, you want higher margin of safety, which means a higher return. So I'm going to go in desired annual return of 12, 13 and a half, and 15. I'm going to go 12, 14, and 16.
Okay.
No, because I think this 2% revenue growth and 9% profit margin is reasonable.
Yeah.
So here's what I'm going to do, 12, 13, and 16.
Fine.
Because I do think that even though the revenue growth number here is low, I think these profit numbers right here are just too high. So let's hit the analyze button. And guys, before I show the numbers, this wasn't a deep dive in the sense of like we're reading the 10K thoroughly, but it's about how you should look at the business. I looked at previous years. You saw that $11 billion year, they had a $3 billion other income. I mean, all these things to factor in. So this is what you have to look at on a year-to-year basis. I want you to understand that you're buying a business, but if the business you're buying has fluke years because of one-offs, you can't include that in the profit number. They're going to have the fluke, right? Same with a write-off. If they have a $4 billion write-off suddenly, don't include that in the profit. It's a one-time event. Add it back in. This is how I want you to look at businesses. I'm not here just to beat the crap out of companies. I'm here to be realistic. Hit the analyze button.
Our price $95.
I mean, look at this. Low side 30, high side 60, middle price 45. This is very, very low. Very low. I actually don't know if I agree with this.
Yeah, I don't either.
We've done other reports where we did it at $80. Yeah. I do think that the profit margin and revenue will be higher.
Why don't we change that? Just change it on the high side.
All right. Well, I actually want to do this. 0, 3, and 6% revenue growth. Okay. 7, 9, 11. 7, 9, 11. And PE.
I think the PEs are fine.
And then for desired annual return. Okay. And guess what? I have my watch list price at 80. Now, the whole point here is we're not sitting here saying, oh, let's just alter the numbers. We're also sitting there saying, let's sit there and take a step back going, what is Disney really doing here? And one of the things I want to look at also is what their price to sales ratio is in history. We don't have that here, but right now they're selling for 2 times price to sales. That's a good thing to look at for the future. So right now, based on this, the stock in 2019 was at, let's call it $110 a share. Well, actually higher, $140 a share. That was an irrational market. In 2014, it was at 80, basically where it's at. When was the last time it was at this today? 2015. The market was overpriced then, but not that bad. And in 2015, what was their revenue? $52 billion. So their price to sales was much higher than it is today. There's multiple ways to look at this company, guys. And that's what I want you to remember. And every single time you do it, the numbers are going to come in different every time. The point is, I'm not coming up with a high price of 30 and a high price of 100 each time. It's 60, it's 80, it's 90, it's 70. It's all around this place of saying, okay, and now that it's getting close to my price, it's probably somewhere around 80 where my watch list price is. I'm going to really take a deeper dive and say, what do I really think the stabilized, normalized EPS is? What I mean by that is taking out all the fluke highs and fluke lows over a long cycle. What do I think the earnings per share will be? And that's what I make my value on. So if you like this, watch more of his channel, watch 4 or 5 more videos, subscribe to the channel. You'll get reminded. You'll be able to watch our videos, and it's awesome. Thanks very much. Take care. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?